You think you own 500 stocks, you don't. You own 7. And if those 7 companies decide to have a bad year, your so-called diversified portfolio is going down with them. This is the concentration risk nobody talks about at dinner parties, but I'm going to break down exactly which 7 companies now control over a third of the entire S&P 500, why this happened, and what it means for every dollar you've got in what you thought was a safe, passive investment. Because here's what actually scares me. Most millennials are blindly pouring money into S&P 500 index funds every single paycheck, thinking they're diversified. They're not even close. And the worst part? By the time most people figure this out, it'll be too late. Let me take you back to 2020. Remember that year? Markets crashed, then roared back. But here's what you probably missed. While the S&P 500 recovered, a handful of mega-cap tech stocks did most of the heavy lifting. Apple, Microsoft, Amazon, Nvidia, Meta, Alphabet, and Tesla, the so-called Magnificent Seven. Now here's where it gets wild. As of recent data, these 7 companies make up roughly 30 to 35% of the entire S&P 500 by market cap. Let that sink in. 7 companies, out of 500, control about a third of your index fund. That means if you put $10,000 into an S&P 500 ETF, roughly $3,000 to $3,500 of those dollars are riding on 7 stocks. The remaining 493 companies are fighting over the other 65%. That's not diversification. That's a disguised tech bet. And look, I get it. These are great companies. They make real money. They have moats the size of the Grand Canyon. This isn't about whether Apple is a good business. It is. This is about whether you understand what you actually own when you buy an S&P 500 index fund. So how did we get here? Market cap weighting. That's the culprit. The S&P 500 isn't an equal weight index where every company gets a fair slice. It's weighted by market capitalization. The bigger the company, the larger its share of the index. So as these tech giants have swelled to trillion-dollar valuations, and in some cases, multi-trillion-dollar valuations, they've naturally gobbled up more and more of the index. Think of it like a party where the biggest person in the room keeps eating more and more of the pizza. Eventually, there's barely any left for anyone else. That's basically what's happened to the S&P 500. Now, you might be thinking, okay, but these stocks went up for a reason. They're the winners. Why is this a problem? And that's a fair question. Here's why it's a problem. Concentration cuts both ways. When the Magnificent Seven are ripping higher, your S&P 500 fund looks like a genius move. But when they roll over, and they will at some point, because that's what stocks do, your index fund goes down a lot more than you'd expect from something that supposedly tracks 500 companies. Let me paint a scenario. Imagine a year where value stocks are up 10%, small caps are up 8%, international stocks are up 12%, but the Magnificent Seven dropped 20%. You'd think your S&P 500 fund would be fine because 493 other stocks are doing well, right? Wrong. Because those 7 stocks make up a third of the index, the entire S&P 500 could finish negative in a year where most of the market is actually doing just fine. That's the dirty secret. Your passive investment isn't passive at all. It's an active bet on 7 tech companies, whether you like it or not. And if you think this can't happen, talk to anyone who was investing in the year 2000. In the late 90s, the S&P 500 became massively concentrated in tech and telecom stocks. When the dot-com bubble burst, the S&P 500 dropped nearly 50%. Not because every company was terrible, but because the biggest companies in the index collapsed, and they dragged everything else down with them. It took 7 years for the index to recover. 7 years. If you were a millennial in your mid-20s back then, you'd have been in your mid-30s before you broke even. That's a massive chunk of your investing lifetime just waiting to get back to zero. So what do you actually do about this? I'm not going to tell you to dump your S&P 500 fund. That would be reckless. But I am going to tell you to stop pretending it's the only thing you need. First, understand what you own. Actually look at the top holdings of your index funds. Know your exposure. If a third of your portfolio is in 7 stocks, you need to be mentally prepared for what happens if those stocks have a rough stretch. Second, diversify beyond the S&P 500. Consider adding small-cap funds. Look at international exposure. Think about equal weight strategies where every stock in the index gets the same allocation, not just the biggest ones. The S&P Equal Weight Index exists for a reason, and over certain long periods, it's actually outperformed the cap-weighted version. Third, and this is the one most people ignore, think about your time horizon. If you're 30 years old and you won't touch this money for 30 years, concentration risk matters less because you have time to recover. But if you're planning to use this money in 5 years for a house down payment or a wedding, you need to be much more careful about how concentrated your investments are. Here's the bottom line. The S&P 500 is still one of the greatest wealth-building tools ever created. I'm not anti-index fund. Far from it. But the idea that buying one S&P 500 ETF and calling it a day makes you diversified is a myth, a dangerous one. The 7 stocks at the top of the index could continue to dominate for the next decade. They could also face regulation, competition, disruption, or simple mean reversion where their valuations come back down to earth. Nobody knows. And that's exactly the point. If nobody knows, then concentration is a risk. Full stop. Be intentional about your investments. Understand the bets you're making, even the ones you didn't know you were making. And don't let the comfort of the word passive lull you into thinking you're safe. If this was helpful, there's more on the channel. I break down money and investing topics like this every week, always straight, no fluff. Take care of your money, and it'll take care of you.